and this virus is
Priya. शर्मा जी हो गया yeah he's yeah
Welcome to those of you who've joined. We'll just give it a minute or so before we get started, as there's still a few people joining. Okay, it's 4:33. I think we can get started now. So good afternoon, everyone, and welcome to a new edition of the Indo-Canada Chamber of Commerce Thursday Talks. We're back after a brief hiatus, and we have an exciting subject and an eminent panel of speakers for today's program. Before we begin, let me just begin with some housekeeping requests. As we are on meeting mode on Zoom, I just want to request that everyone who's logged in keep their microphone on mute and their video as well. And this will ensure that we'll have the ability to provide the platform exclusively for our speakers today. If you do have any questions, we'll have time for that nearer to the end. And you can use the chat mode on Zoom or on Facebook, and we'll ensure that the speakers are asked these questions if we do have time. So with that behind us, we're ready to begin. So let's go on to slide 2. For those of you who don't know me, I'm Priya Devin Chahal. I'm a director at the ICCC, and I'm also the district vice president for Midtown Toronto at Scotiabank. I lead a team of 15 branches across Midtown Toronto, and I've been with Scotiabank since 2016, and in the financial services industry for about 2 decades. So before we get into the actual topic, I just wanted to move into a disclaimer. Since we are talking about financial and investment planning, I just want to let you know that nothing that we're saying today may be construed as financial advice from either the speakers or the organizations that they represent or the ICCC. We're not responsible for any investment decisions that are made out of this discussion. Members of the audience are requested to seek professional advice before they make any financial or investment decisions. Okay, so on to slide 4, and let's get into the topic. So everyone who's here is here to hear about the silver lining in COVID. So we've been waiting for a silver lining, of course. COVID has had a deep-rooted impact both at the macro and micro levels, affecting global economies, national and multinational corporations, large and small businesses, and of course, all the individuals across the world. The process of recovery has commenced, and it's good to see a majority of the population getting vaccinated, but it won't end anytime soon. So what we want to do is talk today about what this means for individual investors. The time is ripe to take advantage of the portfolio and planning for the future. We want to make sure that we're considering regulatory measures that governments have put into place and are expected to continue to keep in place to ensure a good liquidity that's been invested into most economies to override the adversities of the pandemic. So without further ado, let me introduce our eminent panel of experts, comprising of Rakesh Vijay. He's a senior wealth manager at Vijay Wealth Advisory, which is associated with Raymond James Limited. We also have Trevor Perry, who's a senior estate planning advisor, also with Raymond James Financial Planning Limited. And of course, we have Stephen Walters of Stephen Walters Law Office. Each of our eminent speakers are experts in the field of financial and investment planning. So before we hand the platform over to them, I wanted to invite Thosif Sheikh, the 33rd President of the Indo-Canada Chamber of Commerce, to deliver his remarks. Thosif is a seasoned, top-performing banking professional with experience in global banking, retail banking, wealth management. Prior to joining HSBC in Canada, he was also with HSBC India and part of the startup team of the NRI office in Canada. He's also an ambassador for diversity and inclusion within HSBC in Canada, and he believes in giving back to the community. So over to you, Thosif.
Thank you, Priya, for your kind introduction and support. Good afternoon, friends, well-known speakers, and my colleagues on board. Thank you. It is an honor and privilege to address all of you as the President of Indo-Canada Chamber of Commerce. I am the 33rd President of a 44-year-old organization which represent an aspiration and ambition of the fastest growing Indo-Canadian community from coast to coast. I have been associated with Chamber for over a decade now and have been on the board for the last 4 years. This long association with the Chamber has given me a deepened insight into a strong support system that our institution has with the large Indo-Canadian community. The Indo-Canada Chamber of Commerce touches the heart and soul of every Indo-Canadian who have been involved with us, irrespective of level of engagement with the Chamber. They all have strong achievement and attachment to its function, growth, and future, which we will all look to. This great wave of goodwill must translate into achievements. It has been my endeavor since I took the responsibility of being president in early June to ensure that we make this institution strong, robust, and take it to a growth trajectory and achieve new milestones for the Chamber. For this purpose, one of the first initiatives that my team has launched to reinstate the Indo-Canada Chamber of Commerce chapter. For the first time in the Chamber history of more than 4 decades, we now have a fully functional India chapter with members in India. We are pioneers to become a true bilateral organization with presence in both Canada and India market. It will help our chamber faster growth and facilitate the mandate of fostering bilateral trade relations and investment between two countries. It is more comprehensive manner. Our aim is to grow steadily in India with have office in every city where counterpart Canadian Trade Commissioner Service has a presence. This will help us serve our objective. The Canadian small business SMEs, the counterparts Canadian Trade Commissioner Service has a presence. This is also a win-win situation for entrepreneur ventures and startup to being endeavor and give a platform to make this visible and credible in the Canadian market and flourish. Chamber, being the face of the bilateral relationship between the two countries, offers a great opportunity in this regard. At present, Vikas Sharma, as an advisor to Government of India Personal Ministry, is heading our Indo-Canada Chamber of Commerce India chapter. We have already enrolled over 60 members in India, and I am confident that in the month to follow, we will grow and grow steadily with a quality membership in India. I'm also inviting all of our member and stakeholder to get involved in India initiative and help us become a true cross-border bilateral organization. In addition to India initiative, our chamber is now all geared up to start normal operations. We have had a difficult 2020 and most of 2021. We are hopeful that vaccine drive success reaches to all Canadians during this summer, and we will finally able to operate in this new norm. The Indo-Canada Chamber of Commerce is a networking platform. It acquires its meaning only if we meet this objective and fulfill that requirement, and we will provide this platform to our members for networking. We have planned our annual golf tournament, the SME Expo, the annual award function among the programs in personal format. We will also follow Health Canada guidelines in this regard. This is a great opportunity for our members, stakeholders, sponsors, and supporters to interact and each other in person and shake hands, since we all see each other only on a screen for quite a long time. I have really more to share this time today, but today I'm not going to stuck between our great panelists, which is here today, and also with Rakesh Vijay team. So thank you for your time today with us. I also want to thank Priya for moderating our event today. Thank you all for your time. Back to Priya.
Thank you, Thosi, for your insightful words. Indeed, the launch of the India chapter is a major milestone for the 4+ decades of the Chamber's history, and we look forward to further consolidation of the Chamber's footprints across Canada too. And now let me introduce our first speaker for the afternoon, Rakesh Vijay, to share his views. As a senior wealth manager with Raymond James, Rakesh Vijay's mission is to provide clients with trusted investment advice combined with the highest standard of service this industry has to offer. He believes in building long-term relationships with his clients by putting them first in whatever he does. Over to you, Rakesh. I believe you're on mute.
Okay,
There you go.
Hear me?
Yep.
Thanks, Priya. Thanks, the president. We never met before, maybe one of these days. Okay, so Priya, we are a tiny team of 3 people. So my business is wealth management, and wealth management and tax, 2 things are very, very important for any given client. We do all corporate, we do all individual. I'm in the industry since 1982 in financial service industries, and my goal is to help people, the amount of people I can do it. So I will definitely tell Trevor Perry, he needed more time, as well as Steve, to talk about tax. That's very, very important. Trevor?
Thanks, Rakesh. Thank you, everyone, for coming out today. And one day, hopefully, we do this in person, because I think we're all getting quite sick and tired of Zoom, but hopefully we all own stock in the company because I'm sure it's done well in the last 18 months. My standard joke is I'm a former stockbroker and I'm a lawyer, so that when I'm dead, I'll be buried face down, so I know where I'm going. What I want to talk to you today about is, it sounds a little bit crass, but is there a silver lining in COVID? And there certainly is, because anytime there is upheaval like this, and we can't discount the human loss, but anytime there is economic upheaval like this, it goes back to a classic economist's theory of what we call creative destruction. It was a guy named Joseph Schumpeter, and capitalism thrives on this. And we see in certainly capital markets opportunities because of COVID. What I want to talk today about is sort of a unique tax and planning opportunities as it relates to Canada. But when we look at things globally, we have to be objective. There are a number of opportunities that are creating. I mean, in the case of India, I think that you're going to see decoupling, at least from North America, of a lot of the industrial capacity that's currently in China. And I think that India is going to be the welcome recipient and beneficiary of this. So I would be long Modi and short Xi right now, both in the intermediate and long term. That said, if you want to move one slide over, we can start with the main body of this, and I'll try to go through this relatively quickly. So. Okay, so what we are going to talk about today are basically some tax planning considerations, and I'm going to turn this over to my colleague Steve, who has some very detailed and precise thoughts on opportunities for entrepreneurs. Okay, next. No one likes to say winners and losers, but unfortunately there are. As I mentioned, Zoom, something like that is doing extremely well. Telecommunications, conferencing systems, construction is still booming. Couriers, I know the wine courier, the wine delivery business has done a healthy margin on me and my wife in the last 18 months, but then there's others that are not. So anything related to travel, hospitality, anyone in the fitness business has had to become innovative. Now, certainly they've seen a downturn in their business. Will they come back? Hopefully, and this is where we create the opportunity, okay? Canada's COVID response is something also, again, we can't simply be subjective. We have to look at what's going on in tax policy and try to determine, and we're not the Oracle of Delphi, but I think it's fairly easy to understand where taxation has been going under the current federal government and where it's likely to go, and God forbid they are returned in the apparently upcoming election. What do we see as likely tax policy measures? And as we're all in business, we have to be aware of the challenges. This is not a pro-business government by any means, and so we have to be aware of that. Now, what have they done? They've blown up the bank in terms of response. We can discuss whether that was prudent or not, but certainly Canada's balance sheet is a mess right now. We're at historically high debt to GDP. It's not good. So there is obvious political pressure to keep the level of subsidization, the level of support up, and that's not going to go away, particularly going into an election campaign. But the old issue is who's going to pay the piper? Who will do that? It is very likely that everyone on this call, that is high income earners, entrepreneurs, will continue to be the target of tax planning, of taxation. So it's unfortunately good politics to go after the 1%. And I always point that out, that it's $234,000 of net income in Canada gross income in Canada puts you in that 1%. In the United States, it's well north of 600,000. So when they talk about 1% here, really it's just the middle class. But again, with the lens of politics, this is where we're at. What have they done already? Well, anybody who was a incorporated professional knows about the so-called TOSI rules and the tax on split income. The inability you can no longer really pay your spouse dividends unless they are involved wholeheartedly in the business. The attack on the small business deduction, which is a stealth tax increase for those who have saved inside their corporation. A new top tax bracket. I think there's only two provinces in all of Canada that have a top rate of under 50%. And, you know, as Steve and I will know, our friend Conrad Black once commented that short of war, there's no moral justification for the state to take more than 50% of what one person earns. And I wholeheartedly believe that. The 2017 proposals by the now luckily former finance minister were a gargantuan upheaval in tax planning. Just basic common sense. 30 years of established tax planning would have been thrown out the window. All of us know that CRA has been given a virtual unlimited budget. So there's heightened enforcement and audit provisions. Auditors are taking matters into their own hands and often quite wrongly, but trying to enforce their interpretation of the act. And the new reportable transaction rules and promoter penalties are targeting ongoing tax planning. So we've got to be aware that this stuff is coming down the pipe, or is here, and more coming down the pipeline. What's next? I think if you talk to the accounting community, it's fairly baked in that the inclusion rate, which is currently at 50%, will go to 75%. That will result in capital gains rates of 40%. That's pretty considerable. A wealth tax. Mr. Singh is talking about this all the time for families with an aggregate net worth of 10 million or more. You're going to get hit with some kind of annual tax. So those things are easier to deal with, but because it's pure politics, but that's in the cards. And yes, even the principal residence exemption is talked about. Now, a lot of people would say that's a political third rail. They'd never do that. But consider this: if they were to take the average house price for your traditional liberal voter, let's say $750,000, and say, okay, that's going to go tax-free. Everything else, capital gain, and they layer on the 1% stuff, it's conceivable that that measure could even be introduced. What else do we see happening? Post-pandemic possibilities. For those who aspire and are entrepreneurial, like everyone on this call, they have to be aware. They have to be concerned about what's going on. Tax policy continues to be confiscatory. It's not going to go away. They don't think innovatively. How can I raise money in innovative fashions? I mean, if you look at some of the European countries when they've done patent boxes and things like that, we should be looking at that, but we don't. There's a massive upheaval in the economy, both macroeconomically and microeconomically. This is for all of us an opportunity, and it's also a clarion call, a call to action to defend what we've already built. So I'm seeing just a deluge of interest and tangible action for people trying to reduce current and future tax liabilities and doing it prudently. I'm also seeing a lot of people saying, okay, I'm done. I love this country. It's a beautiful place. It's a great place to live and raise children. I always say Canada is a big, beautiful, boring country, but the flight of capital, both personal and corporate, out of Canada is profound. People they're terrified. They're not terrified, but they're very worried, and they're looking to protect. So what do we want to, what are some of the strategies that we want to be considering? Well, I'm not going to cover all of them today, but one of them is we want to talk about double taxation at death. We want to talk about means of reducing future and current tax liabilities. I want to talk about estate freezing or corporate freezing. That is what I think, and my friend Steve Walters can talk about that. He's an expert on this transaction. But for businesses that have reason to want to freeze their values for tax purposes, now is the time to be considering this transaction. Okay. A lot of folks who, if you're in business and you have a corporation, a lot of people don't realize that you face in Canada the peril of double taxation. We don't have a state tax like the United States does. Certain politicians have talked about it, but we don't have it. What happens is you're deemed to have sold everything at the moment before death. If your spouse is still around, there's a rollover available, but eventually that piper is paid and you have a capital gain. Currently 26.7%. If we get that inclusion rate increase, you're at 40. Now understand, if you have a corporation, that is not a corporeal being, but it's a legal being, and it survives you. And in order to pass the wealth associated with your corporation along to your kids, along to your families, you have to wind that up. You have to redeem the shares. that's a dividend. If you don't get the timing right, you pay both. If capital gains rates go to 40% and you get trapped in a double taxation trap, about 84% of your corporate value will be lost to tax. So for everyone in business, you have to be on top of these issues. It's with simple planning, you can avoid double taxation, but the call to action is you have to do it. Okay. Corporate freezes are something, again, that Steve can speak to, but I'm seeing them all the time. And it works for both those who have suffered in terms of value in COVID and those who have benefited. The more tangible case you see is those who have had a depression in the value of their company. If they were worth $20 million 2 years ago, and they owned, things that have been particularly hurt, and they're now worth 12, well, there's the ability to freeze the company. And what that is, it's a reorganization of the share capital, where you're going to freeze those values, in this case, at 12 million. And then the future growth of the company is going to be passed on to the next generation. But if that individual knows their business is going to bounce back, it might take a while, there's a considerable bit of tax liability that's going to be avoided and those savings locked in immediately. So freezes are critical. As I said, they're reorganizations. What happens is that the founding generation simply takes back fixed value preference voting shares. They still control everything. And the kids, usually through a family trust, will get floating value shares. But this is it's a tremendous and long established transaction that should be done. And for the companies that have done well, you have a scenario where my camera's gone out. Who knows? Where again, locking in value now, but moving the future growth off into the kids' hands or the next generation's hands is the critical thing. Okay, let's see if that does it. There it is. The bald man is back. So post-mortem planning, this deals with our double taxation issue. What we're finding now is that we can demonstrably reduce tax. So if we have, in the context of a freeze, you have a company that's coming to you saying, look, I'm worth $5 million less than I was, but I want to take advantage of that immediate tax savings and future tax savings, but I also want to make sure that I pay as little as humanly and legally possible to the government upon the passing of the founding generation. That's post-mortem planning. And that's where we're using innovative things like insurance shares. And I'm not here to, talk wax poetically about insurance, but I've got to tell you that insurance remains the only large-scale, widely available tax shelter in Canada. When we do post-mortem planning, it is quintessential. It is a must that insurance is included because we simply cannot reduce the tax demonstrably without it. So we get into a discussion of insurance shares, which reduces the capital gain on death. And then what happens is that we end up using capital dividends, which are created with insurance proceeds, to redeem shares, at least half of them in most cases, with tax-free money. So most of the time, and again, depending on your age and how long we have to fund these things and how we structure it, we routinely get final tax bills down to between 8 to 12%. It is possible to do zero, but that involves usually smaller businesses. I would probably say in the $5 to $8 million range, professional corporations and that kind of thing. Again, we're not here to do a tax 3-hour symposium today, just to do the highlights that you want to be aware of, particularly in this tumultuous time of change. Now is the time, as I said, it is a clarion call for action to start talking to your advisory group about that. Okay. Why insurance? Insurance, again, is the big one. Is it's exempt from taxation. So think of it as an accordion folder. It grows and grows and grows. It expands with time. Inside of the accordion folder is money, invested extremely conservatively, in many cases guaranteed. But that growth is not taxed. If it's just held in your corporation and you hold that portfolio in your corp, you're going to be taxed at 51%. not with insurance. Insurance is an asset. I know lenders who prefer to lend against insurance than real estate. And we're doing a lot of that these days where we are in essence using the bank's dollars to create the necessary capital dividend credits for all our planning. So an advanced transaction, but one I'm very comfortable with. And that would be another topic that we can discuss someday. But the key is that everything associated with life insurance, the growth of it, and for most part, the payment out of the death benefits are tax-free. And with that, we create magnificent results in tax planning. Okay. Over to you, Steve.
Priya. Now's a read. Can you hear me, Priya?
Yes, I wanted to before we began, we did go from Rakesh directly to Trevor, and I just wanted to make sure I got that intro out of the way before we moved on to you as well.
No. Well, before you move on to me, I think now is a good time to distribute that pop quiz to everyone about Trevor's presentation. Now's a good time. I mean, at least the good news, it's not long answer, it'll just be multiple choice, but now's a good time to distribute that. Yeah.
Okay, we'll do so. I mean, I just wanted to thank you, Trevor, for that presentation, and you can see why Trevor's known as a financial tax and insurance strategist, bringing a really pro-business attitude to his endeavors, as well as objective analysis. So your qualifications definitely shone through there. And if we do have questions for Trevor, please do put that into the chat, and we'll get to those a little bit later on. But now I wanted to welcome Steve Walter. So I'm assuming Steve also has a nice legal pop quiz to give to all of you today after his presentation, and I guess you'll be graded accordingly at the end. So over to you.
Good afternoon, everyone. I am happy to help Trevor answer any questions you may have on his presentation. Mine takes a sort of a different look at COVID. I've been dealing with a lot of very different issues over the last few months. Of course, I've had a number of clients that are very concerned and they've had business troubles, but I've also had a number of my clients who have been able to identify opportunities. In my practice, I really do focus on sort of assembling resources and opportunities and helping clients structure their businesses and their personal affairs. And ultimately, as everybody likes, it's to make sure that they can make more money, and when they make more money, keep more of it. So whether the business is contracting or expanding, it's really about preservation and how to do that and how to manage that process. And those are the types of things I spend most of my time on in the course of a day. So you can well imagine that I've had lots of interesting things to deal with over the last few months. From that experience, what I've found is and some of this is going to be fairly obvious, but for the purposes of completeness, I should probably say it. And you'll see that I have just as many. Well, no, I don't have very many slides, do I, Trevor? I only have the one. Look at that. And the things I want to talk about, again, you'll all know about them, but I think there's an opportunity. We've come through a challenging time, and we have to be creative and look for opportunities. Now is the time to make sure that you're taking full advantage of all government opportunities. If there's, for federal and provincial, do everything you can. In light of what's happened, I know that there are a lot of people who have had a very difficult time. Personally, I've been very busy, but I'm still looking for personally, I'm still looking for the opportunities. Do I need to take some of the rent relief? Can I defer it for some reason? Is it my benefit? There's still an analysis to be done, and I would encourage everyone to look into those opportunities. With any government program, you can well imagine the other side of it is, please read the fine print. It's very important to read the fine print. The governments have a bad habit of launching a program and then without notice, they'll change the circumstances or change the requirements. And there really is no way effectively to hold them accountable to that. Complaining doesn't help, and it's expensive. Now's a good time to speak to your bank. There's opportunities, and you should look, if you don't have a cash flow facility that's sufficiently large for your business and to grow and help you accelerate into opportunities, now's the time to go back to your bank, look for a cash flow facility. Those cash flow facilities are generally based on assets and results and things like that. So you've got to be able to manage those, but still, if there's an opportunity there, you should look into it. Something that I've been working with my clients, as much as I'm a corporate and commercial tax lawyer, but part of my practice is I have a separate office that does nothing but AR collections for my clients. And it's because I didn't find there was an effective answer out there. A collection agency doesn't do it. They just don't do it properly. They don't pay attention. But now's a good time to look at your accounts receivable, pay attention to them, put a process in place to follow up about them. It's important that you maintain those things. I am amazed at the number of clients and new clients I've been able to bring on board, specifically from a collections perspective. Large clients that you wouldn't expect that had organizations, and divisions within them that you think would be more efficient. But you're trying to help, and you allow credit where perhaps you shouldn't. Now's the time to tighten it up. Now's the time to make sure that even if you can't bring that cash flow in right now, to make sure that you've done what you can to solidify that it will be paid in short order, and deal with that. In terms of workplace reorganization, things that a lot of business owners may not think about is, do you have any inventory that you're not going to use? There are lots of people out there that, while you may not be using that inventory, other people it may be useful to them. Sell it off, get cash. Do you have equipment that you don't need, or other assets that you don't need? Do you have the right mix of equipment and other capital assets to move forward? Now's an excellent time to consider that, to consider upgrading, and again, to adjust those things to prepare for what you see as the future. You can tell I'm terribly bullish on these things, right? I expect my clients to be successful. I demand that they be successful, and I demand that they be optimistic and plan for it. If you've got a large facility, do you need a large facility? Can you move? If you move, how can you adjust? If you can't move, can you sublet? I have a client that had some concerns, but they had a big fenced yard, and they were able to sublet some of the space to trucks. Safe and secure place. And again, it's a small bit of revenue, but it's effective use of an asset that otherwise would not have been available to them. And again, downsize. You may want to, this may be the opportunity to downsize and sort of rationalize operations. Workforce reorganization. This is a really tricky one. A lot of the issues I was dealing with over the last few months had to do with employment law. And there's a whole gamut of everything from human rights issues and how to manage them, and of course in sensitive areas, daycare centers, and how to bring people back into daycare centers, so that their parents can go to work. I've had to deal with an amazing number of daycare centers and the complexity. So what I did take from this is that there are, daycare centers aside, a lot of clients, of course, we all know that we're trying to work from home. We're all trying to do that. If you're running a business, now is an interesting time to say, okay, well, if the landscape is changing, maybe it's now time to come up with new workplace policies. Now's the time, all those things that were irritating and that you felt like you were herding cats with employees, now's a good time to put workplace policies in play. Under other circumstances, unless you're, attentive to these things, you may be running into circumstances where there's allegations of constructive dismissal, valid or not. But if there's going to be a significant change in the complexion and the way that your workforce delivers their services to you, now is a good time to take advantage and reorganize it in a way that makes you comfortable and make sure that it's effective for your business. This is also an opportunity I run into a lot of clients even before COVID where they're getting ready to sell, but they don't have the normal restrictive covenants. They don't have confidentiality agreements. They don't have non-solicitation agreements and things like that. If all of a sudden, this COVID came upon us so quickly, now that this is becoming more regularized, you can, you've got a chance to breathe and you say, well, wait a sec. I want to make sure that, I've got these restrictive covenants in place. Now, with a changing work environment and everything up in the air, there is an opportunity to implement that along with other changes that will help you align your workforce, with the direction you want your business to go. Perhaps as difficult as you may think this is as well, now may be an opportunity to adjust your workforce. Maybe you want to get rid of people. Maybe you want to change the skill sets you have available. Again, now's the time to do it. There are opportunities to do that. And sort of the corresponding, the other side of the coin here is that with so many competitors and there's so much mobility in the workforce now, perhaps now is a really good time to poach talent from someone else. Maybe Scotiabank could use somebody from RBC. Right? Now's the time to look for those things. When it comes to your customers, you've all heard the 80-20 rule, that 20% of your customers generally bring in about 80% of your revenue. Now's the time to revisit those customers and make sure the relationships are strong. Now's the opportunity to see if you can move some of the 80% and move them up. And let's see if we can get a 70-30 split. Again, AR management, pricing policies, payment policies. These are all things that you could look at in connection with a review of your customer or client base. With respect to suppliers, as Trevor said, Trevor made some points. He said, the construction's doing very well, but gyms aren't doing so well. You have to understand that there's going to be I've had a number of clients, I'll tell you, a number of clients that their customers did think that they were unbearably strong companies. They had been in business for decades and decades, and they were shocked and amazed at how financially weak and fragile they were. They were important, pivotal, strategic suppliers to many of their customers. And then they were simply gone. And there was no one to talk to. Well, except for me. It wasn't fun. But, they simply, they've been there and they've been providing you with product or services for your friends. You're friends with, you know them so well. But they don't tell you how fragile they are. Now's the time to perhaps consider your pricing, consider other suppliers, multiple sources of that critical inventory that you need. And to manage your supply, do you need as much as you've been getting? Make sure you don't overbuy. This is sort of the Costco problem. It seemed to make sense when we bought bundles and bundles of toilet paper back a year ago, March. But I'm not sure if anyone's ever been able to go through all that they bought in March, so I don't know if you need that much inventory. And now's the time to consider that and perhaps streamline that in the business. And then there are new opportunities. As I mentioned, there's opportunities to reconsider your pricing models. You know that the industries that you're in may be shifting and changing. You know that there's some competitors that may be leaving the marketplace. There are some competitors that are, maybe leaving a particular space, a product or service space. it may be time to look at that market and figure out if you can adjust your pricing and whether you've got greater efficiencies within the business or opportunities looking outside the business from customers. Now's the time to, now's a good time to do that. Can you, prior to COVID, we were all very busy and we get into a habit. We've had an adjustment. We've had to stop. We've had to breathe. Those errant thoughts you had when you were too busy more than a year ago, are those markets still available? Find new markets, find new opportunities. I had a client, and it was a small manufacturer of a very simple product. He made cardboard boxes, and small manufacturer, and he was having a terrible time because he could simply not compete with a large cardboard box manufacturers. There were a number of them, and he was complaining. And I talked to him, and I said, you've got the machines, you've got this. What else can you do? I mean, it's a material, and I brought his attention to, and perhaps some of you have seen it. The things you can make out of cardboard. You can make castles that you can assemble for small kids. They're like razors. It rains and they melt, and you got to buy another one. They're inexpensive, but it's an innovative way. It's again a way to use existing equipment to make a different product in a different market. So now's the time to test that out, right? So new markets, new products, new services. If you see, I saw a lot of very, very significant insolvencies over the last, there's a lot of smaller companies that simply stopped. But there are a lot of, I'll tell you, the Toronto courts are very, very busy now. I've been on a number of calls and before judges about larger insolvency matters where, equipment intensive businesses just didn't work. Can you buy those businesses? Is there an opportunity to buy a competitor, buy a market share, buy their equipment, buy their talent? There are opportunities. You need to be looking for them. My first point was about financial resources, and everything I've said after that seems to sound really, really expensive. I know. And you have to pay attention. But the other thing, and everybody's heard of shred credits, I have had a lot of clients in the past that have not been able to take advantage of shred credits, largely because they couldn't get organized enough and structure the management of their business and and keep dockets and time logs to be able to successfully apply for those shred credits. Consider that. Consider how you may be able to do that. They are, as any government program is, they are difficult in the application the first time, maybe the second time. But after you get into a habit and you understand that and you have a bias towards innovation and growth, you understand how to do this and they become increasingly easier to complete and easier to comply with the requirements. And even in the short term, I have a number of clients that have figured this out, but because of cash flow needs, they know they are eligible for the credits, and you can actually get those financed, where a company will come in and they'll take control of the shred process, but they'll give you money in advance in anticipation of the credit being returned to you. Shred is perhaps one of the ones we're best familiar with, but I went looking a little while ago. There used to be a loose leaf binder, and I saw it when I went to visit an accountant. It was green, it was enormous. And it was a loose leaf because it had a list of every government loan and grant opportunity available. And I have gone looking for this book since, and I'm not able to find it. I don't think it's published. So what I actually did is I had a student here last summer, and I had them download and look at all of the ones that I thought may be applicable to my clients. There are hundreds and hundreds and hundreds of grants available from municipal, provincial, and the federal government. and loan support and things like that, for whether it's for students and employees and starting, or equipment or innovation and things like that. Yes, I know they're painful, but it's free money or cheap money. And if that's what you need to do to accelerate out of COVID, that's good use of your time. With the government made it quite easy for us, with a lot of the support programs for COVID to apply. But there's so many more out there. There's hundreds and hundreds that you need to take advantage of. And to assist with all this, I was in fact in a conversation with my accountant today, and we were going through how I operate my business and my financial statements, and we were just talking about geeky tax stuff. And he mentioned to me something that, of course, I had read, but he said, pay attention and tell your clients about this. And I said, okay, sounds good so far. Right now, the government's come out and said there is, for your capital cost allowance, you're able to deduct 100% of assets that you buy for production. I asked, it will not apply to a Ferrari. I cannot buy a Ferrari with that. But if you buy something for production, you are able to deduct 100% of the value of that equipment in the next year. So there are ways to do it. That's money, again, relief deferred, but it's still all these opportunities add up. So I'm hoping, Priya, that I don't have a pop quiz. Priya, you got to turn your microphone on.
Sorry about that.
That's
so we
okay.
do have some questions that I wanted to get to Rakesh with. So the first one is, what trends have you seen in the environment and market over the past 16 months?
This for me?
Yes.
Okay, somehow we got very lucky in wealth management side of the business. And, I'm in the industry for a longer period of time, and I understand things, how the things goes. Lots of time when I see whether 2008 or 9/11, anything happens, the people just hit the button and say, everything is gone. Sky is going to fall. And lots of advisors say they're hiding under the table, not responding. And they say, okay, the client said, what is happening? We're going to sell it. And all the portfolio has been sold. That's a big disaster in this industry. So end of the day, the loss is the client's loss. And I very clearly understand market is going to go up, but patience is very important. So anybody comes, and we are very unique business model. We do all custom portfolios. We do not sell any in-house products, and we look after plus addition of tax planning and all those things. Very, very important. And my team is there, and I have a lot of focus on having lots of tax planning. Coming back to this one, since 16 months, fortunately, with all my mandates, the portfolio is all in good, positive territories. And lots of money is flowing in, because when the time comes, is everything on sale? And 99% time, I understand people outside, plus I got a lot of new clients come in, is being sold. And as I tell you, when he is sold, I don't know when they're going to catch the train. It's very difficult. So it's very important. And I basically hired three more people in my office to get now most of the clients during pandemic and even now portfolio is being managed almost daily basis. We are not hoping what will happen next day, but we want to see what is happening today. And if we need to rebalance, we rebalance quickly. So those things worked out very, very well in the last several years. And I still on with Trevor and Steve to help clients for tax planning.
Perfect. So you answered question 2 as well. So I'll move on to the second one, which is, what's your approach to financial planning for your customers and their households?
Okay. So number one, we are not. Okay. So let me rephrase it. Coming back to how really we look after our clients. Number one is that everybody, most of the people know Raymond James is a full service company. We do not have no product to sell to the clients. So we see if the client's mandate or client's requirements are very reasonable, then I take those accounts. Somebody want to make 20-30% every year is not a good client for me because I cannot do it. My most of the 99% portfolios, they are all medium risk growth portfolios. There's no speculation at all, zero. Sometimes people want to buy some investment, they're high risk, and cryptocurrency and whatever, those sort of things. I'm really not very excited to give it to my clients because they fall into highest risk commodity. Coming back to this one, and I educate my client, educate the people they really wanted to do business with us, is who we are, what we do, and what we don't do. We cannot make people rich overnight, but we want to protect them, not become poor. And over a period of time, once we are doing rebalancing portfolio, we talk to the clients personally. I make phone calls, my portfolio managers make phone calls and see, this is your portfolios right now. Out of this, 2 need to be turned around, and rest of the things. We have to add some 2 or 3 portfolios, 2 or 3 stocks, and we are all good to go. So it's happening every single day, and I can tell you, nobody does it in the industry. So we are very, very unique. So we want to see its mandate is matching with our mandates. Perfect. So that's what it is.
Perfect. And how has your approach changed or altered at all during COVID in terms of how you help your customers?
That's a great question. So COVID is also a teach lesson. We were not that aggressive to looking after portfolio on daily basis, but now we learned this pretty quickly. And then that's why I hired more people, and we service our clients every single day if need be. But portfolio is being managed on daily basis, no matter what. Portfolio is a 15 million portfolio versus $500,000 portfolio. All portfolio or all the clients are being equal. We do not ignore people or ignore clients. They have like $500,000 versus the people, they have 15 million plus. So for us, all clients are equal, service equal. We pick up the call, 99% time, all the phone calls is being taken right away. Turnaround time, 1% out of 99% is 5 minutes. So we try to give best service, educating clients. So that's why the client doesn't go that far, hit the panic button, sell the portfolio. Doesn't happen in my office because they are being educated from the day one. Every single time when we have a conversation. And I like to do a lot of discretionary managed portfolios, but in IROC platform, discretionary managed portfolio, I don't have to call the client. I can do whatever I want to do. Rebalance portfolio is being done automatically. But I decided not to do that. I still do all portfolios. I basically reach out all my clients on the basis when I'm doing rebalancing. So at least 18 to 20 times a client is being talked or being. So, it's really, relationship is very, very important. It's not, and my business is not like business. It's more on relationship, and I'm into it. And I want to make sure everything is doing correctly.
Some good points around education, financial literacy, and relationship. So I just wanted to turn over to the chat for a minute. We had a question for Trevor, and he did also note that for some reason it says Frank on this slide, but his name is Trevor, just to confirm. Sorry about that in terms of the slide. The question is from Sanjay. We hear that the boom in the housing sector is caused by overseas money coming to Canada. And in the M&A sector, the supply of capital outweighs demand. You said that the money is flowing out of Canada. Is there data to support that?
Certainly there is. I mean, there would be both from government and non-governmental sources, a plethora of data indicating an overall decline in business investment, and you could break it down into sectors. I mean, if you go to Alberta, it's a crying shame what's going over there. Then there's a lot of it that's anecdotal. So I remember in the Tory leadership contest, Kevin O'Leary was pounding the table saying there's tens of billions that have already gone out. He would know. Certainly the lawyers and accountants that I speak with on a regular basis, they're indicative of that. I can tell you from my own experience that interest or indications of interest in what I will call exit or international tax planning is incredibly more active than it was 24 months ago. I have been told in conversations with folks I've met who are in fact not of my political persuasion that that money's running, personal and corporate, and it's seeking safe haven. Whether the real estate market's a function of foreign buyers, I'm sure that's part of it. I think it's also it's cost push inflation, and it's historically low interest rates that are doing that. So there's a combination of things. But I'm telling you, from my perspective, it's not a pretty picture. It's not that Canada is going to get kicked out of the G7 or anything like that, but there's certainly indications that all is not well, and that capital is agnostic. It's going to run, and I think that there is enough evidence to see that happening. Look at things. How many consultants are out there doing expatriate planning? And it's not just downtown Toronto. I mean, if you look at things like Nova Scotia, they're terrified that they're going to lose their medical community because they have managed to maintain the highest income tax rates in the entire country. And why do you want? It's a nice place to visit, but it's got a lot of winter. So if you choose that in Florida, what are you going to do, right? It's an easy choice. So is there evidence? Absolutely. Is there a plethora of anecdotal evidence that this is going on? Yes. Will it get worse if tax rates continue? If the capital gains rates go up, if Bill C-208 doesn't go through. I mean, as you all know, you're in business. It's easier to sell to your next door neighbor than your kids. That's ridiculous. And this government wants to stop the act that just went through. So it's not a positive environment for business. I don't, by any measure, unless you're, unfortunately, the banks. The current government loves Bay Street. They want to squash Main Street.
Okay. There's one other question from our ICCC president, Tausif Sheikh. He's asking if there's any forecast on the Canadian dollar to the greenback and also the forecasted view for oil pricing. For anyone, any of our speakers.
Trevor.
I'm not qualified to make the call, but from my political compass, as long as the government south of the border and north of the current government here have an anti-oil bias, which both of them do, oil prices will remain high.
Okay. So what we can do, we can bring.
Rakesh has experts. He can put up a report.
I'm going to bring the chief portfolio manager here. He is Model.
Hello, guys.
Okay, so what's your question again, Priya?
Yeah, I heard it's about the Lumi and the oil, right? So oil prices, there is a diversity of opinion at the moment. what I believe is that current oil prices are high enough to help the oil producers to increase their production, which will put a downward pressure on oil prices. So my thinking is that currently within the range of 65 to 75 is more or less where the oil should be. Currently it is 72, somewhere around. And what happens is at this moment, oil producers are making money hands over fist. So a lot of oil producers which had shut down their oil fields have again started production. So yes, oil prices are going up because of economic growth, but there is downward pressure also from the OPEC and from the US shale producers and so on and so forth. So current oil prices should be the top of the range for now. The other thing is about the Canadian dollar versus the US dollar. So Canadian dollar appreciated quite a bit because of the commodities going up. So whenever commodities go up, usually Canada benefits and Canadian dollar also benefits. But I think that is also reaching the end of its short-term range. So probably for the next year, you may see US dollar appreciating slightly versus the Canadian dollar. As of now, there is no real forecasts explicitly about the Canadian dollar, but more or less people's opinions are that it should be slightly up for the US dollar versus the Canadian dollar from here.
Okay, fantastic. So it's been a great discussion. Unfortunately, we've run out of time, but I do want to, first of all, thank our speakers, thank our sponsor, Rakesh Vijay Wealth Advisory, and Raymond James. It was a wonderful discussion that we had today, and of course, great significance to all of our members in terms of managing their hard-earned funds. So thank you so much to all of you for joining. I did want to acknowledge the support of our long-term sponsors as well. That's our gold sponsor, Turkish Airways, as well as our sector sponsors, SBI Canada Bank, ICCC Bank Canada, Seneca College, Vijay Wealth Advisory that I did mention, GTT20, and TELUS Business. I also wanted to have a special thank you to our media partners as well, the Weekly Voice, PTC Punjabi, and ATN. And finally, a big thank you again to our eminent speakers for finding time to participate in today's webinar and really making it so relevant and interesting. Our sincere gratitude to all the participants and members of the audience for being with us this afternoon. And please do write to us with any of your chamber-related needs. Thank you so much and have a wonderful evening, everyone.
Thank you so much, Priya.
Thank you.
Thank you.
Thank you so much.